The ages right after you turn 60 until you're about 70 is the golden years of tax planning, my friends. You've heard it here many times here at the Heritage Wealth Planning YouTube channel, but now we get validation, if you will, from the internet. And if it's on the internet, just like Abraham Lincoln says, if it's on the internet, it must be true. But actually, let's dive right into this because I think it's pretty interesting from my good buddies over at Kiplinger.com. And Kiplinger is a wonderful resource, actually, and you should definitely look up what they're writing about. But they do talk about the golden decade of tax planning is upon you once you hit the age of 60. So don't forget to subscribe down below. As always, thumbs up, comments help me immensely. Share the video with friends on Facebook and other social media. All right, so let's talk about this. We got Golden Decade offers golden opportunities to get taxes under control. If you are between the ages of 60 and 70, the time could be right to pump some money out of the big fat 401ks and traditional IRAs into tax-free Roth accounts. Where have we heard this before? Oh yeah, your old buddy Josh. This is Scott Dugan, who's an RFC/investment advisor. I don't know what an RFC is, with Elevated Retirement Group, and writing in November 2018. If a financial planning professional planned your 60th birthday, the balloons and steamers wouldn't be black. They'd be gold, he says. Some advisors even refer to the ages between 60 and 70 as a golden decade because those years are filled with opportunities to make meaningful moves to protect your retirement savings. You'll be making decisions on when to file for Social Security, how to maximize your pension, and you should be checking out your Medicare options before you turn 65. Yep, and yep. But it's time to get serious about tax diversity. It's also a critical time to do about the tax efficiency of your retirement plan. At age 59 and a half, you'll no longer have to deal with that intimidating 10% withdrawal penalty from a tax-deferred retirement account, except if you're a public safety employee. Remember that now, because of bipartisan legislation in 2015, you have access to your retirement plans after the age of 50. If you're separating from your current employer after the age of 55, you also have access to your retirement plans with a 10% penalty, as long as you separate from service after the age of 55. All right, if you haven't already done so, it's a good time to get some tax diversity in your plan and to better balance the accounts you have in tax-deferred, taxable, and tax-free accounts. And as I talked about a lot here, I got my little chart. Tax-deferred, tax-free, Roth IRAs, tax-deferred IRAs, and taxable accounts. Oops, just banged my light there. That's because so many savers keep all or almost all of their nest egg in a tax-deferred retirement account, a 401k, a 403b, a TSP, which means they still owe taxes on the hundreds of thousands or even millions of dollars they've been stashing away for years. And whatever they're taking from that account, they'll have to pony up to the IRS at whatever the current tax rate is, and Social Security, and Medicare premiums, and qualified dividends, and long-term capital gains. But here's the good news. Thanks to reforms that start this year, most folks will be in a lower tax bracket through 2025. No matter what your age, the next few years will likely offer a sweet opportunity to reduce the tax bite you're bound to experience in retirement if you're a big-time 401k saver. But if you're in your 60s and can avoid the tax penalty and take advantage of the lower tax rate while converting some 401k money over to a Roth or even just taking it out to spend, you're looking at some powerful motivation to get going. You can convert a little each year for the next few years, filling up whatever the tax bracket you land in, or even bump yourself up a tax bracket or two if it's not too painful, i.e. how much of a check you got to write. Of course, you're going to have to pay tax on that amount, my friends. No getting around that. But the money will never be taxed again. It'll never be subject to Social Security taxes, Medicare taxes, the whole thing. And you won't be forced to take RMDs. Your surviving spouse won't be forced to take RMDs. And while your children will be forced to take required minimum distributions, they still will not have to pay tax on it. Your financial advisor and CPA can help you run the numbers to determine what's best for your situation, but you can be pretty confident that the individual tax rates we'll have for the next few years that the individual tax will have the next will be lower than what's down the road. Okay, so he's basically saying the tax rate is probably going higher. We'll see. Of course, no one can predict what tax rates will be after 225, but the expectations will have to go up in order to deal with the nation's growing debt and the unfunded liabilities on Social Security, Medicare, and Medicaid. Someone's going to have to pay for that. And historically, tax rates have been much higher than they are today. And I'm just telling you, I don't even think the tax raised so much, so as more as just the other effects on Medicare, Social Security, long-term capital gains, and qualified dividends, and other sources of income that you have. I could easily see that going up It has nothing to do with your income tax. Everyone hates income tax increases, but you have these other taxes, and they can't be one for one blamed on Congress. They can't. So they'll say, oh, we had nothing to do with it, kind of like the indexing of Social Security. Now, it's possible they haven't given much thought to what your tax rates will be in the future, but you may be told your taxes will be lower in retirement, and because you'll be spending less income. I've never understood the idea that by default your taxes are going to be low in retirement. Not if you have RMDs, required minimum distributions. They probably won't. If you keep your lifestyle pretty much the way it's been, or even take up a notch, given all the extra free time you have, you'll need money to pay for it. Your income sources won't be the same. You're going to take more and more from your retirement accounts in order to fund your income needs. A percentage of your Social Security payments could be taxed if you're combined. We talk about this a lot about your the provisional income tax. If you're single, up to $25,000 of provisional income is not taxable, but anything above $25,000, the amount of your Social Security benefits subject to tax will be 50% or 85% or a combination thereof. If you're married, $32,000. If anything below $32,000 of provisional income, and again, provisional income is all of your income, including your tax-exempt tax-exempt interest from municipal bonds, plus half of your Social Security benefit. That's your provisional income. If that amount right there is above $32,000, a portion of your Social Security benefit will be taxed, up to 85% in total. Meanwhile, you'll probably lose some significant tax deductions. I agree. Your kids will be gone, grown up. Yep. You no longer have a mortgage. I completely agree with that. So you're probably not even going to be itemizing anymore. The standard deduction doubling to $12,000 for single, $24,000 for married couples. Only 10% of Americans will continue to itemize going forward, and those are probably not the people who are making $5,000 or $6,000 a month in income. It's going to be the Mr. Burnses of the world. The bottom line is not, as the old saying is, it's not what you make, it's what you keep. Understanding the impact taxes can have on your nest egg, and not overpaying is one of the keys to happy retirement. I think there's many keys, but I completely agree with that. If you're hyper-focused on the investment diversity in your portfolio, you need to do the same for taxes. Could not agree more. So anyway, I just figured I'd share that with you. I thought that was pretty good. I'm a big fan of Kiplinger's, and I don't know Mr. Dugan here, but I absolutely love his article. Again, I'm surprised he didn't focus on Medicare premiums. That's okay. That's okay. And then the change of Medicare premiums potentially because of your RMDs, and also taking a zero tax asset for long-term capital gains and qualified dividends and making them taxable. That's okay. He's hitting on the head. He's basically getting a triple here, and I completely agree with that. So the golden years of tax planning, 60 years old to 70. If you're separating from service in a regular 401k after 55, same thing. If you're a public safety employee, public safety, if I said public service, it's not public service, it's public safety. I forgot what I said initially, but it's public safety. Police officer, fireman, EMT, border patrol, customs, and there's one other I'm missing, but I forgot. Anyway, if you're separating from service as a public safety employee at the age of 50, you have access to your money without that 10% penalty as well. So as always, comments, questions, thoughts, put them down below. Go to the blog at heritagewealthplanning.com, and we'll see you next time. Thanks. And don't forget to subscribe. Thanks, guys.